November last year, the industrials market broadly is up approximately 20-odd%. The market peaked in about May this year, May 20th actually, and what we've seen since then is a broad retracement. But it has been a retracement in the sense that every sector's gone down. There have been some that have outperformed. The ones that have outperformed mostly, in line with the Australian dollar correcting, has been US dollar names. So what you've seen is the ResMeds of the world, the News Corps, etc., have performed quite well. And while what's happened also is the yield trade's unwound as well. So the banks, the REITs have underperformed quite markedly, down up to 15%. So since the May peak to basically as of today, the market's down about 12%, with a lot of the financials doing the hard work. So as it stands today, our portfolio was sort of prepared for a Australian dollar correction, but mostly the value. We saw the value in the US dollar names. So as we go into now, we're starting to see some opportunities in those sectors we've been underweight, which is the financials. We've had a large underweight in the banks. Now, as I look forward from here, given the market has corrected, we've got some very reasonable multiples in the market. The market's down to about 13.3 times PE. The price to book's about 1.5, and the dividend yield's about 5.5% again. So the corrections allowed some good valuations to start appearing, and some good sectors to start to look going forward. We're seeing particular types of sectors, say some domestic cyclicals, who are now being priced as though the Australian economy is going to sort of a recession. I'm not of the view that that's going to occur. I look at it, if you look at the last 5 years in Australia, you've had a high currency, very high relative cash rates, and a pretty tough industrial relations market, given the government's view on industrial relations. If you go forward at least 6 to 12 months, we've already got very low cash rates, so that's going to translate into very low mortgage rates. The Aussie dollar's already corrected 10%, and post-September, I suspect there's going to be a change of government. We should see a more stable environment for business. Now, they were 3 headwinds are going to become tailwinds. And consumer confidence is okay still. I think with the change of government, that might improve. As we go forward, corporates have been reluctant to spend, given the rather unbalanced view from government regarding business. So I think going forward, they'll be more willing to spend CapEx expansion. So, and with an Aussie dollar weakening, you've got the retail, construction, manufacturing and tourism sectors, which have all been going backwards for 5 years, are now looking okay. They've got at least some benefits out of a change in economic variables for Australia. So still, I'm quite positive on the industrials. As we stand today, the market has re-rated, and in the industrial fund itself, I see great opportunities.